All right, now we are going to start the property, plant, and equipment. And the property, plant, and equipment is one of the most important standard when it comes to the exam. Remember when you started your first financial accounting paper, there you studied the definition of the asset. When you started your first paper of the financial accounting, you started with the asset, and the definition of asset was that asset is actually a resource of the entity, and this resource is controlled by the entity. And the second was that future economic benefits are probable. These are the two things you studied over there. That asset is actually a resource which is controlled by the entity. And remember one thing, when we talk regarding the accounting, when we talk regarding the financial accounting, we always consider the term control rather than owned. Like there can be a situation where something is not owned by you, but still it is being controlled. Like for example, you go to the bank and you lease a car for you. Unless and until you are done with all the payments, legally the car remains at the name of the bank. But who is using the car? You are using the car. Who is taking the benefit of the car? You are taking the benefit of the car. What if the repair is required to the car? Who is going to pay for the repairs? You are going to pay for the repairs. So when you see in the legal terms, the car is on the name of the bank, but you control that car. In accounting, we always see the control thing rather than the legal form. This concept is known as the substance over form concept. That we always see the commercial substance, we always see the economic realities rather than legal forms. So remember that we always look for the commercial substance for the economic realities rather than legal forms. So an asset is a resource which is controlled by the entity and from which future economic benefits are probable. And one more thing to understand is that future economic benefit is not only something in terms of the inflows. Like future economic benefit can only be a thing which is coming to the organization in the form of the money. Like for example, you have the machine, you're using it, the machine is producing the units and you are selling those units. The future economic benefit is not only related to the inflows. Let's assume you have an asset which has reduced your electricity expense. This is a future economic benefit as well. You have a resource which is producing more units now. This is a future economic benefit as well. So future economic benefit can be anything. It can be inflows, it can be cost savings, etc. The third criteria to record the asset is the cost is measured reliably. Because we are supposed to record the asset in the statement of financial position. And the statement of financial position, we need the monetary amounts to record that asset. A resource which cannot be quantified, which cannot be assigned values, cannot be recorded as an asset. This is the most important thing you need to know. A resource to which the cost cannot be assigned cannot be recorded as an asset. So there are three conditions, there are three criteria to call a resource as an asset. The first thing is should be controlled by the entity. That means risk and rewards, not the legal form. The second thing is the future economic benefits are probable. Now, future economic benefits is in terms of either inflows or savings, etc. And third thing is the cost can be measured reliably, or the cost can be reliably measured. If these three criteria are met, then we say you can record a resource as an asset. And then you moved further and you discussed two broad categories of the asset in your earlier financial accounting paper. You studied the current asset and the non-current asset. And over there, you studied the major differentiation between current and non-current asset is that the current assets are the liquid assets. Current assets are the liquid assets. These are the assets which are easily convertible into cash. For example, the receivables or the cash itself or the cash at the bank. And then these are the goods for the sale, goods for resale, for example, inventory. And the third thing was that these are realized within 12 months, realized within one accounting period, realized within 12 months. So the examples were receivables, example were cash, examples were inventory, example were prepayments. All of these are the current assets. And then we studied the non-current asset, in which we said the non-current assets are the asset whose life or benefit is more than 1 year. Is more than 1 year. And there we studied this thing as well, that these are not the assets which are held in the ordinary course of business to be sold. Like we do not sell these assets in the ordinary course of business. Like for example, we have the machinery. We use it in the business. We do not sell the machinery in the ordinary activity of business. Now, ordinary activity means when you sell those things. For example, you talk about the Honda, they sell the cars. You talk about the Toyota, they sell the cars. The ordinary activity of the business to sell cars. When you have the ordinary activity of selling something, that is known as the goods for sale or the goods for resale. That is the inventory. But when you are keeping any asset for the business use, then that means it is a non-current asset. This was your financial accounting knowledge, earlier financial accounting knowledge. And then you moved one step further and you studied that within the non-current asset there are two types: the tangible non-current assets and the intangible non-current assets. Tangible non-current assets are the assets having physical existence. Intangible non-current assets are assets which do not have the physical existence. For example, you have the goodwill, you have the copyrights, you have the brand name, all of these license, all of these websites, software, all of these are the intangible non-current assets. So this was your earlier accounting knowledge, that we used to call a resource as an asset if it is controlled by the entity. That means the entity has the risk and reward associated to that resource. The future economic benefits are probable and the cost can be reliably measured. We used to call that resource as an asset. And then we studied two broad categories: current assets and the non-current assets. Current assets are the liquid assets, the good for resale, and these are realized within 12 months. The non-current asset, what the assets, who those assets which is other than the current assets and the life is benefit or the benefit is more than one accounting period. And then we studied the tangible non-current assets and the intangible non-current. Tangible assets like the physical existence, vehicles, plant, machinery, equipments, and intangible ones having no physical existence, which means brand, copyrights, etc. Now, when you are studying the property, plant, and equipment, which is IAS 16, it is quite clear that these are the tangible non-current assets. You see from the name, property, plant, and equipment, these are the tangible non-current assets. But one thing you need to understand is before putting any asset within IAS 16, you first need to see whether that asset meets the classification criteria of the IAS 16. Now, because you are studying the financial reporting now, not the financial accounting. Now you need to see the classification first, and then you will be putting any asset within the property, plant, and equipment. Let me give you a plain example uh, to deliver this concept. For example, you have a property. You have a property which is being given on the rent. Now, because you have the property which comes under the name of property, plant, and equipment, You have a property which you see that can be classified within IAS 16, but that property is being given on the rent. Can we classify a property which is being given on the rent within IAS 16? So the general answer should be no. Now, you will be amazed to see that, you will be amazed to hear that you have a property which is being given on the rent. The property looks like that it should come in IAS 16, but we are saying no, the property should not be classified under IAS 16 because it is being given on rent. So this is the reason why we need to see the classification criteria first before before putting any standard within IAS 16. Another example. Another example. We have a plant. We have a plant which we have planned to sell, and we are not using it and we are selling it. We have a plant. Now, can we classify that plant within IE 16 which we are selling? The answer is no. Now, again, the plant, you can see from the name of the standard, comes under IE 16, but why we cannot classify that plant under IE 16? Because now we are selling it. So that means before putting any asset under IAS 16, you need to see the classification criteria first. Now let's discuss the classification. The property, plant, and equipment are tangible assets with the following properties. Held by an entity for use in the production or supply of goods or service, for rental to others, or for administrative purposes. The first thing is that these property, plant, and equipment are the tangible assets. We know that. Okay, these are the tangible non-current assets having the physical existence. Held by an entity for use in the production. For example, machinery. Machinery is used in the production to make the goods. The machinery is being used to make the goods. So machinery is the property, plant, and equipment. For example, you have a business of dry clean. You dry clean. Now you are using those dry clean machines to dry clean the clothes of your customers. Now those dry clean machines are used for the business, held by an entity in the production, stitching units, assembly lines, anything which is being used in the production, or supply of goods or services, for example, vehicles. Like for example, Pepsi company, when they receive an order from their customer, they have their own vehicles which are going to deliver those goods to their customers. For rental to others. Now remember, when we are saying rental to others, the rental should be the business of the entity. For example, rent a car business. Like you probably have heard regarding this business, like they give the car on the rent to the customers. For example, we are going to have a trip, an office trip in which all the colleagues will be going to one place. We'll be having a meeting over there. We'll be having a fun over there. We'll be having some chit chat over there. But we are many people. We need, let's assume, we need a coaster, or for example, we need a bus uh, so that we can all go together. We contacted a company who is a rent a car or a rent a bus business, and they said, okay, we'll be giving you the bus for a full day with driver on this rent, and I will be charging this much amount from you. Now they have a business of the rental. They will be giving us the bus on a rent for a day. That bus is earning revenue for them. So the buses should be recorded as the property, plant, and equipment. Or for administrative purposes, for example, you have the computers, you have the equipments, you have the furniture, you have the fixtures, you have the fittings. All of these are known as the property, plant, and equipment. So remember one thing. The property, plant, and equipment are the tangible assets having physical existence, held by an entity for use in the production, for example, machinery, or supply of goods or services, for example, vehicles, for rental to others, for example, when you have a business of rent a car, rent a bus, and even, for example, giving heavy machinery on the rent for the road construction or anything, or for administrative purposes such as computers, fixture fittings, furniture, etc. And expected to be used during more than one period. That means the life or the benefit is more than 1 year. The entity will be taking the benefit of that assets for more than 1 year. Okay, now we have the recognition, which we have already discussed. An item of property, plant, and equipment should be recognized as an asset when. Now, this is the criteria of the asset which we have already discussed. That the asset is a resource which is controlled by the entity from which future economic benefits are probable, and the cost of that asset can be reliably measured. So it is probable that future economic benefits associated with the asset will flow to the entity. The cost of the asset can be measured reliably, because if you cannot assign the values to that asset, that means you won't be able to record it in your statement of financial position. And these recognition criteria apply to subsequent expenditure as well as cost incurred initially. Now, this is something important to understand. Initial initial expenditure means when you are first buying that asset. So when you are first buying an asset, obviously you will see whether it meets the asset criteria. Once you have bought the asset, then in the subsequent expenditure means once you have bought the asset, and after that, if you're spending something on that asset, you need to see whether the asset criteria is again met. Because if the criteria is met, then you will be adding that thing in the cost of the asset. Otherwise, it should be expensed out. So this is something related to the capital and revenue expenditure, which we'll be talking in a while in the next slide. So the asset criteria should be applied for initial recognition as well as in the subsequent expenditure. Another important point is, like, IAS 16 provides additional guidance as follows. Smaller items such as tools may be classified as consumables and expense rather than capitalized. Where they are capitalized, they are usually aggregated and treated as one. Now, for example, in the classroom, I am having the board markers. The board markers are used to write on the whiteboards. Those board markers are being used by me in the classroom to write on the whiteboard so that students can see what I'm writing. Those board markers cannot be recorded as the property, plant, and equipment. They should be treated as consumables. Similarly, the duster which I use to remove something which is being written on the board should be treated as the consumables. For example, in the office, we need to print something. We have the printer pages. Those pages should be treated as the consumables. Even, for example, the cartridge which we are putting in the printer should be treated as the consumables. If you go to a barber shop and they have disposable scissors and etc., those even should be treated as the consumables. They cannot be classified as an inventory because they are not selling it. They are using it for the business. They are using that thing in the business. Those should be recorded as the consumables. Even, like, for example, the nuts, the bolts, the screws, those should be treated as consumables as well. But if you're having a complete toolkit, like for example, you go to a barber shop and they have a very nice Caesar kit. Now that should not be treated as the consumable. They can aggregate the complete toolkit and record that thing as one asset. So where they are capitalized, they are usually aggregated and treated as one. But smaller items such as tools may be classified as consumables and expensed rather than capitalized. Okay, now is the measurement at recognition. And this measurement at recognition means the initial measurement. The initial measurement. At what value we should initially record the asset. So property, plant, and equipment should initially be measured at cost. Initially be measured at cost. Now, cost is simply the purchase price less rebates. Obviously, this makes the complete sense. If we are buying something and we are having a discount on it, we are going to take the net amount of it. For example, you bought a machinery for $100,000 and they gave you the $50 discount, then obviously the net amount is $950, which should be taken as cost. And if you are importing this asset, then import duties should be capitalized as well. But these import duties should be non-refundable. If these are refundable, then you cannot capitalize it. Similarly, non-refundable taxes. If the taxes are refundable, like usually companies, they can, just file a refund for many types of taxes. So if this is a kind of tax which can be refunded, then you cannot record the tax as in the cost of an asset. It should be non-refundable. And even the import duties, it should be non-refundable. Directly attributable cost of bringing the asset in the working condition for intended use. This is something in addition to the purchase price. Let purchase price plus any cost to bring the asset in the working condition, any directly attributable cost to bring the asset in the working condition. For example, employee benefit cost. Like for example, if you're constructing the asset yourself and you are paying to your employees, employee benefit cost, the labor, site preparation or clearance. This is again the relevant cost, directly attributable cost, initial delivery and handling cost, installation and assembly cost, professional fee, cost of testing, and this is one-off testing. One-off testing. For example, I have bought a stitching machinery, like I have my own business, let's assume, of stitching the shirts, and I bought a stitching machinery. So I do not know how to use it, but before using it, I just want to test it whether it is correctly fitted. So I called a professional, I called an expert to come and just make it test whether everything is fine. So an expert was contacted and they said, okay, we will be charging you $1,000 to test your machinery, whether it is completely fine or not. I said, okay, we'll be paying you for it. So that cost of testing should be capitalized as well. Let's assume it is $1,000, then it should be capitalized. But there is one important concept related to that, and I'm sure you will understand that easily. Like we were testing our machinery, and in order to test it, we just stitched some shirts during that. Let's assume in order to show whether the machine is working properly, that expert took the stuff of 3 shirts and stitched it during the testing stage. And those stitched 3 shirts can be sold now to the customers. Let's assume those shirts can be sold for $200. Now we will be capitalizing $800 as the cost of testing because the expert took out $1,000 from us. During the testing, they stitched 3 shirts which can be sold for $200 by the business. So that means the net cost of testing is $800 that should be recorded. And then another important concept is site restoration provision were not included in the cost of the inventory produced. Now, what is this site restoration cost? This is known as dismantling cost, and the other name is decommissioning cost. So there are three names of it: restoration cost, dismantling cost, and decommissioning cost. There are three names for it. So dismantling cost. The present value of these costs should be capitalized. Now, what is this? First, you need to understand what is dismantling cost. This is your contractual slash legal obligation to dismantle or to restore or decommission the asset by the end of its useful life or by the end of the project. Contractual slash legal obligation. Contractual slash legal obligation to dismantle the asset, to restore the asset, or decommission the asset by the end of its useful life. And obviously, when you have a contractual or the legal obligation, then when you are restoring it, when you are dismantling it, there will be a cost attached to it. And that will be a future cost. When it's a future cost, then you need to estimate it. This should be the best estimate. And you cannot capitalize the future cost as it is. You need to calculate the present value of it before it is being capitalized. All right, fine. So dismantling cost is a contractual or legal obligation. It's the future cost. So that means you need to make a best estimate of it. And before capitalizing it, you need to calculate the present value because the future value cannot be capitalized directly. You have studied this thing in your F2 exam that first it needs to be discounted by using the discount fraction or the discount rate. And the formula for calculating the present value is future value 1 plus r raised to power minus n. And r is the rate of interest and n is the number of years. And the process through which we calculate the future value we take the future value to the present value is known as the discounting. And you probably know this from your F2 knowledge. This is known as the discounting. Let's take an example. If an oil rig was built in the sea, the cost to be capitalized is likely to include the cost of constructing the asset and the present value of the cost of dismantling it. Like they're extracting the oil from the sea and they're obviously installing the machinery over there, the cost of constructing the asset, and then there is a present value of cost to dismantle it, because once they are done with the extraction of oil, they cannot leave the machinery over there. They have to restore the site. If the asset costs 10 million to construct and would cost 4 million to remove in 20 years time, now the cost of constructing that asset is 10 million. Obviously, this is the cost of construction. It should be capitalized. And then the associated cost of dismantling it, restoring the site is 4 million. But this 4 million will be incurred in 20 years time. Now we need to calculate the present value of this 4 million. For calculating the present value, we need the interest rate which is being given, that is 4%. So the formula should be present value equals future value 1 plus r raised to power minus n. Future value is 4 million. Okay, 1 plus r is 0.05. We take that thing in the decimal, 5% divide by 100. So it gives you 0.05 in decimals. Minus 20, n is the number of years. So the present value you get is 15,07,558. Like the present value of 4 million, which is 40 lakh. The present value of 40 lakh is 15,07,558. So we have calculated the present value of 40 lakh and it is 15 lakh 7,558. And we have studied that this should be capitalized as part of the cost of the asset. Okay, fine. So we are going to debit the asset by 15 lakh 7,558. Fine, debit asset. Now, where this credit entry is going, credit provision for dismantling, why we are recording a provision. So again, your F3 knowledge. Provision is a liability of uncertain timing and amount. And we know this concept. Provision is a liability of uncertain timing and amount. So it's a liability that it's a liability you have to restore the site after 20 years. You know the timing of it, the 20 years, but the amount is being estimated. So the amount is uncertain. That is why we are calling it as provision. So it's a legal or contractual obligation that you have to restore the site after 20 years. That is why you are going to record that thing as a liability. So you're going to make an account, T account for provision. The opening balance of the provision will be 15 lakh 7,558. So debit asset, credit provision. The total amount to be capitalized will be 10 million plus 15 lakh 7,558. The total will be this 11 billion and something. And this amount should be depreciated over 20 years because we know that the depreciation is the allocation of cost over its useful life. The depreciation is the allocation of cost. We spread the cost over its useful life, and this is known as the depreciation. This is easy till here. But another important point to understand is that if we keep recording this liability for 20 years, don't you think the liability will be understated? Like the same concept, if we keep recording the asset at 11 million and we do not depreciate it, every year the asset will be losing their value. And if we keep recording it at 11 million, then according to the prudence concept, we have overstated the asset. The same concept applies in the case of provision as well. If we keep recording the provision at 15 lakh 7,558, then that means we have understated our liability. How we have understated our liability? Because our real liability is 4 million, not 15 lakh. And the actual liability is 40 lakh, not 15 lakh. 15 lakh is the present value of that thing. So what you have done is, first of all, you calculated the present value of the future value. The total liability was 4 million. And you brought that figure to 1.5 million and something, 1.507 million. Now, systematically, you have to take this amount to the 4 million. And when systematically you will be taking this value to the 4 million, this concept is known as unwinding. This is very important concept for the exam. And I need your attention for it. What we have done is we have calculated the present value of the 4 million, which is 15 lakh 7,558. If we keep recording this figure for 20 years, then that means we have understated our liabilities because our liability is actually 4 million, not 15 lakh 7,558. So every year we have to unwind it. Unwind means we will be systematically compounding it so that after 20 years it becomes 40 lakh. Now, how this can be done? We use the 5% rate to discount it. We will be using the 5% rate to compound it. The same rate. 15 lakh 7,558 multiplied by 5%. The figure you get is 75,378. What we'll be doing, we will be adding this amount in the provision by the end of year one. And the closing balance will be 15 lakh 82,936. This will be the opening balance of the next year. 15,82,936. Then again in the next year, by the end of the second year, you will be multiplying this balance by 5%. Again, you will be adding it. Then it becomes the closing balance. Then it becomes the opening balance for third year. Then again 5%. After 20 years, automatically this figure will become 4 million. So every year we are increasing our liability. This concept is known as unwinding. So the double entry to record is debit profit or loss, and this represents the finance cost, interest expense, finance cost. Because we use the percentage to discount it, then again it should be recorded as the finance cost. So debit profit or loss 75,378 and credit provision for dismantling. That means provision will be increased by this amount and the debit entry will be recorded in the statement of profit or loss as an expense, interest expense. And I can give you the logic that why we are recording 75,378 in the statement of profit or loss. You see, we are depreciating 15,07,558. Ideally, 4 million should have been depreciated, but we are only depreciating 15,07,558, which is the discounted amount, which is the present value. Ideally, the 40 million, the 4 million, sorry, 40 lakh should have been depreciated. So what we are doing is we are depreciating 15 lakh 7,558 and the rest is being charged to the statement of profit or loss in the form of finance cost. So automatically that 4 million will be recorded as an expense in the statement of profit or loss. So this is a very important concept that first of all, you have to calculate the present value and then you are going to unwind it. All right, there is another example over here. An entity builds a research center in the rainforest at a cost of 2,50,000. Having signed a contract with the local government to dismantle the center and restore the land after 10 years. So the cost of building the research center is 2,50,000 and this is for 10 years. And then they have to restore it after 10 years according to the government decision. So that means this is their legal obligation. And the cost will be 100,000, which will be incurred after 10 years. The interest rate is 5%. So if we calculate the present value of that 100,000, it comes 61,391. So debit asset by 61,391. This will be added in the building cost. The total cost will be 3,11,391. 250 for the building and the present value of the restoration cost is 61,000. This will be depreciated over 10 years. And then we'll also make an account for the provision. The opening balance of the provision would be 61,391. But this is not the amount we are supposed to pay after 10 years. So that means after every year, we have to take this amount leading towards its original amount. So 61,391 multiplied by 5%, it gives you 3070. The double entry would be debit profit or loss, credit provision. That means it should be recorded as an interest expense. So the provision account is being credited due to profit or loss, and the amount is 3070. This becomes the closing balance. And for the next year, it becomes the opening balance. Then again, 5% will be added to it so that after 10 years, this will automatically reach 100,000. So when you discount it, it is known as discounting. When you take it to the original amount systematically, that process is known as unwinding. So remember, if in the exam, examiner is asking you what figure should be taken to the statement of profit or loss. So there are two figures that should be taken to the profit or loss: depreciation, and the other one is going to be the unwinding, which is the finance cost. The finance cost. If the examiner asks you what should be taken to the statement of financial position, Either it is going to be the assets carrying value, which simply means 3,11,391 minus its depreciation charge, or the provision. If they are asking you regarding the provision, the closing balance should be taken in the liability. So you have to see what the examiner is asking you. If they're asking you regarding the total charge to the statement of profit or loss, so you're going to take two things, depreciation and unwinding. And regarding the statement of financial position, they will be specifying if they are asking the assets carrying value or the closing balance of the provision.